Hey everybody, Preston Brent here with Trader User Group's weekly roundup for week ending May the 2nd, 2014. I've got on the screen here the E-mini S&P 500 futures. As you can see, we're still comfortably inside the channel, but I'm seeing signs that we're getting a little bit weary here. Let's kind of zoom in and I'll show you what I'm talking about. If I put the RSI on here, you can see at the bottom of the chart, and let's just blow this up a little bit. You can see here that we are getting bearish divergence in this situation. You can see each of these succeeding highs in the RSI as we're coming close to hitting these highs here. We're getting this bearish divergence here. So that tells me that. And Friday we ended, just slightly in the red, not very much. But I think we'll probably test 1867.50 very quickly and come back down to my 1846.50, which is right in this area here. This past week we had some interesting numbers come across from the FOMC and the Feds to Friday's unemployment numbers. I think initially the markets moved up very favorably, but they didn't know how to react to some of the other deeper embedded statistics that came out with the employment number, primarily the workforce participation rate. A lot of people are not finding jobs, so they're bowing out of the workforce, which in turn tends to drive, believe it or not, the unemployment rate down because the number, the denominator, is getting smaller and smaller. So while the numerator, those that are working, stay constant, so that drives the employment rate down. It's just the way the U.S. government calculates unemployment. The true unemployment number is probably still in double digits. But you can see here how this market, we had this ping up here very close to the 1887 level, almost intraday, and then we reversed. This is a very bearish candle, as you can see here on Friday. And that's not to say that I think the market is just going to turn overly bearish, but I do believe that the market is very skittish right now. You can take a look at this candle as I blow it up here. You can see here how after the unemployment numbers that came out, we shot up, almost hit the 1887.50, and then we reversed and closed near the low of the day. Now, so that range was, a pretty good range from top to bottom. A little bit over 14, 15 points, E-mini handle. So you can see down here the 50 EMA is sitting right around 1851. But I do believe we'll probably come back down and hit this 1846.50 area, which was an intraday high going into the end of 2013. And then we got this upsloping line here, which is the south side or the southern side of the upsloping channel here. So I do believe we're going to find ourselves back down in this area here, let alone we've got the bearish divergence here in the RSI, as I've showed you here. The other thing that I wanted to show you is the MACD is also confirming the bearish divergence. You can see here, as I got this chart drawn here, you can see here that we're basically making lower highs in the MACD like that. So that tells me that we came in here, we opened there, we came up here, and then we closed down there. So 1867.50, I think we're probably going to test fairly quickly. And then, possibly down here to 1846. I don't think we're going to get very bearish, at least for now I don't. But that's kind of where the market is sitting right now. If we look at the Dow, now the Dow is being one of the more conservative of the indexes because it's one of the larger cap equities that we have. If we look at the Dow futures, you can see here that we came up intraday high. Again, very similar kind of pattern here to the S&P. You can see here that from the December end of 2013, and then a recent high at 2014 at 15 or 16,574, I guess. And then all of a sudden we've got, today we came back up and we tested the 16,540, and then very similar to the E-minis, the S&P 500, we came down and we closed down here. So I think we may come back down and test that 16,172, but clearly we got to come down and hold the 50 EMA at 16,270. These are the Dow futures. But again, looking at the chart, you got that bearish divergence setting up on the MACD, and then again, if I show you the RSI, you'll see the same pattern right here, right? If you take a look at the RSI, I could draw the line that covers this, and it basically goes just like that. That's bearish divergence, as we're making these highs here. So I also would not be surprised if we had a spike up an interim close like that, and then we gave it all up, something like that, to flush out uh, um, people that are in the market here. So that's what I think seems to be the more probable cause right now. Now, if I were to show you the Nasdaq was down, but we broke the channel, which is really nice. You can see here Nasdaq had a pretty good hard reversal when we hit this solid support area right there that I'm showing you in this colored zone here. Very solid support, about 3,400, and we bounced from the lower southern boundary of this regression channel all the way up, and we punched through, and we're sitting right on the 50 EMA now almost. That's the next R1 level, the resistance level, 36, 35, 25. I'm not sure if we're going to have the energy to get up to it, but we need to have the Nasdaq come up, take that out to get further lift and elevation in the Dow and the S&P 500. We need to have that happen. But the one thing that's got me concerned in all of this is the Russell. If we take a look at the Russell, here's the Russell futures. This chart looks entirely different from every other one out there. This is clearly in a down mode. And you can see here, like NASDAQ, so far anyway, we're holding this key support line right around 1080, right? And you can see that key pivot there at 1078. So we're right in that key support area here. But you can see we're still comfortably within the bounds of this downward channel here. We couldn't quite get up to 1141, but an intraday reversal here in the Russell also tells us that we still got potential more weakness to come. Now, the other thing about all of this is that we've got in the Russell, we've got a situation where the Russell could actually do harm to the other indices. The Russell is small cap, higher beta, higher growth stock type companies, and this clearly has broken out of the channel. If we just kind of scale it back, you can see here, just kind of how this is looking right here. This is back over going into January of 2013. We stayed very tight, and then we finally broke out of the channel right here. So, and while this is not quite a perfect pattern, you could probably argue that we may get one of these kind of things right there, which looks very similar to a head and shoulders pattern, being the left shoulder, the head, and the right shoulder here. And then if we break and we do come back down there, we got a moment of truth at this key point. If that breaks, we're going to come back down to this area right here, which is around, just slightly below 1,000. It would test this key area right there, that support area right there. Now we have a couple of key pivots we would test along the way, these right here, as we come down. But the measuring objective of a head and shoulders pattern is very simple. You take the height of the head to the shoulder, and then you apply it like that. And that would be the measuring objective right down in this area there, right around 960. Now, if we do get down there, that would be during the summer months of this year, and the old adage, sell in May and go away, and then we would have probably the opportunity for some great opportunities should the market do that. If it does do this, we're going to be shifting over everything to the downside, but I wanted to just kind of show you where things are starting to shape up right now. Now, even though the markets fell a little bit, the one interesting thing was the VIX. If we look at the daily VIX, the VIX actually closed down on Friday. So that would seem to indicate that the markets are not that concerned, or at least for now anyway, the markets are not concerned. The VIX actually closed down 34 cents. You can see here, let me just blow this up a little bit so that you can get a better view. The VIX measures volatility, and the lower it goes, the less worry is in the market. You can see in this little area right here over the past week, the VIX is clearly going in that direction. I think we're about done with this downward VIX. I think the probability of the VIX now favors more an upside move than a downside move, which would then coincide with the downside potential movement in the U.S. equities. But you can see this very strong support area right here for the volatility. When it gets down around this level, well, the odds favor to move up. The VIX actually closed down to 1291. We haven't been below 13 in quite some time. You can see right there as I draw that line in how we're sitting. If I were to just draw it another way, just so that you guys can see just where we're sitting, you can see how, through not counting the last 3 weeks in January where we had that really momentary freak show with the markets going down, we've been pretty much in this range right here, north and south of the border. We're now right down at the bottom of this area. So we haven't seen this in over 3 months, this volatility down this low. And you would think with all the things coming up, volatility would certainly be north of here. So I'm not sure of just how much more downside momentum volatility's got. So this is where I would say the risk of a bigger move right now with vol is up. So any of you option players out there and traders out there, our members, if you're going to play a bullish strategy or a bearish strategy, just make sure that you're long volatility in that trade. Now, a couple of other things that I do want to show here, which are very unusual but interesting. Let's take a look at Treasury bonds. These are 30-year bonds. We had a huge move in bonds on Friday, a huge move. It initially sold off dramatically. This candle looks just the opposite of the equities candle. We had a big sell-off in bonds when the unemployment numbers came out on Friday, and then they went way up. And we broke this key level. You can see right here, this break. We were sitting in this area for quite some time. Every time we've come up there, we've pretty much sold off, right? And now we're finally back up at that level right there. I do still favor bonds to come back down somewhere in this area right here over time. I just don't know how long it's going to take to get back into that area. And then between then, we can just kind of ramble up a little bit before it rolls back over. Now, our members, we need to follow what we call the emedemas in our charts. But for now, we got to be very careful. I just picked up a couple of small shorts in the bond market at the end of the day on Friday, just to see if we do get a quick pop back to the inside of these two support zones here. But if bonds goes much higher, then that's going to be further assurance that the U.S. equities are going to go down. And just to show this, let me show you the 30-year interest rates. Look at this right here, folks. As I zoom in, just to give you a better picture here, look at the support area. Let me just zoom in just a little bit more. This is a weekly chart. You can see this 30-year support area. It is very strong support, strong pivot. You can see where it served as support, and we finally broke it right here. We broke it clearly to the downside. Now we've got a pivot here that we're going to probably test, right? In that area there. So we could see bonds go down a little bit lower. I don't think bonds are going to stay down in this area very long. You can see here for this is 2013 right here, all of 2013 right there. So that was, and you guys saw what equities did 2013, but you can also see interest rates continue to go up, meaning bonds are going down. But now starting in this year in 2014, it's just the opposite, right? If I were to just show you interest rates just for 2014, right? You can see right here, this is where we are. We entered 2014 interest rate rise in the 30-year up here, and then we're down to there. So clearly the bond market is saying we are very nervous about the potential movement of U.S. equities so far this year. And if we were to put a channel on that, well, it doesn't take a rocket scientist to say which direction is that going in. So I want to see a clear break to the upside. And notice we've got the 50 crossing the 200 EMA. I pointed that out before. So we've got some key areas here that could signify there could be potentially more trouble ahead in the U.S. equity markets in May and June. I do believe if we do get a pretty good 10% pullback in May, June, July timeframe, come August, September, we're going to start to roll back again. So that's a little bit about a couple of things I wanted to show you. A couple of other things that show you the uh, uh, let's say some ratio charts, which I really do like. They give you a pretty good heads up on what's going on in the market. If we look at growth over value, this is a ratio chart where I'm dividing a growth equity or growth ETF over the value ETF. This is clearly, I mean, again, doesn't take a rocket scientist to see the direction this chart's going in. We're going hard down like this. And when it goes down like this means money basically is flowing out of the it's flowing out of the growth stocks, and money is coming into the value stocks, right? They're going from growth into value. That is a clear case of risk coming off the table, all right? Now, until we can broach this trend line, I didn't draw it very well, but broach it back to the upside, get above the 200 EMA here and the 50 EMA, then money is still seeking safety, which is evidenced by the bond market. It's evidenced by the value over the growth, or growth over the value ETF. And then another one that's a very simple one to do is consumer staples over discretionary. And let me just see here. So here we go. Here's discretionary over staples. Again, it almost looks like the exact same chart. Discretionary in the numerator, staples in the denominator. When this chart is going hard down like this means that risk is coming off the table. People have to buy food, but they don't have to buy big screen TVs. Unless you're my brother-in-law. But this tells me that until we can break this trend line to the downside, it is telling me that we got to be very careful. And this can go much lower. But if we can break this to the upside, we can break this and we can break that, then that tells me that, risk is going to slowly start coming back into the market. Clearly, we're in a down mode. And by the way, this started happening big time in March. Right in March is when all the trouble started. And even though risk is slowly coming off the table, as I've shown you guys, right? Even though risk is coming off the table, what we've got here in the E-minis, you wouldn't know it because if you look at the E-minis, it goes, hey, we're fairly comfortably tight up into this range up here like that. We're still at these all-time highs or very close to it. But with that risk still coming out of the market, if it continues like that, we're going to fall pretty hard, folks. So that's what we're watching going into next week. We're going to watch the Russell. We're going to watch the Nasdaq, and we're going to watch, just where is risk and where is money going, and bonds. These are key things that we got to really stay and pay attention to. All right, everybody, if you're a member, we will talk to you Monday or Sunday night for the coming week. If you're a non-member, check out that special offer that I have here for membership and coaching. I think you guys will enjoy it. We're having fun in 2014. I'd like to see you on board. Have a good one, everybody. Have a great weekend, and I will talk to you later. Bye now.